Hi guys, welcome back to the Financial Interest YouTube channel. My name's Dan. So let's talk about growth rates. So growth rates are one of the most important things about investing. So the whole reason people invest in the first place is we want our money to be able to work for us. We want the money to compound over time so that we're going to get something more back in the future. So we'll also use our future growth rate as part of a discounted cash flow analysis. This is going to form the basis of what we use to project the growth into the future. And when I'm talking about this, I'm talking a long-term time horizon for this, so at least the next 10 years. I'm not looking at companies who've just IPO'd or anything like that. I'm looking at companies with a solid record of growth already. And remember that in this situation, we've already done our analysis of the company. We simply now need to find a growth rate. So we've put in all of the hard work with research already, with the meaning, moat management, and now we're just looking for a price so we can get the margin of safety. So there's quite a few different things we need to consider when we're trying to come up with a growth rate. So first we need to consider what stage the business is actually in. Obviously businesses go through a lot of different phases during their lifetime. So each company will have a startup phase, then you might move into a rapid growth phase, and then see some maturity, and then the kind of next phase would be either the company finds a way to reinvent itself or it actually will go into a decline. So these are the main four stages that we're looking at with a business. And also we need to take into account the size of the business we're already looking at. If we're looking at a fairly small cap company, then it's realistic that the growth can be higher than a really large company. That's just the law of large numbers. It's much easier for a smaller company to grow at a faster rate than a larger company. And we want to also look at previous performance of the company. Obviously, this is not going to give us an exact indication of what they're going to do in the future, but we want to be able to look back into the past and see consistent growth. So you can't drive a car while looking in the rearview mirror, but actually it does help to at least be able to go back and see that the company's got some historical records of growth, because that's a good starting point to try and project the growth forward. And another key point is you want to think about the growth runway ahead. So what's the total addressable market? That's sometimes known as TAM. So you need to think about, does the company still have a lot of runway ahead of it for growth? Are there any kind of adjacent markets the company could move into? Maybe they can expand into international markets, that kind of thing. So an example of this might be a restaurant chain expanding internationally. Could also be something like Disney, obviously having streaming with Disney Plus. So these are all things you need to consider when looking at the possible growth into the future. And you can also look at analysts' growth estimates. Now on Yahoo Finance, there is a section which will show the analysts' growth estimates for the next 5 years. You can also go and use this as part of making a judgment on the growth. So now we're going to go and look at how I come to growth estimates. So we'll go and take a look in a couple of places. The first one I'm going to look at is the Real One Toolbox. So this is something that I actually subscribe to, but I think you can get a free trial if you sign up. But also Phil Town's got some calculators on his website as well, so I'll leave a link to those in the description. So we can see here that Phil Town uses a number of different measures for the growth rates. So here you've got book value plus dividend growth rate, then earnings per share growth, operating cash per share, and sales. And each of these shows the percentage over the period of time. So this is the compound rate over 10 years, 7 years, 5 years, 3 years, and over the last year. And the reason that Phil's using quite a few different numbers is so that the numbers can't really be faked. So if you look at earnings per share, that's something that if you're doing a lot of share repurchases, that's artificially going to inflate your earnings per share. So the reason for using 4 different metrics is to kind of avoid that. So we can see here, looking at the 10 years for Apple, they're 12% and kind of going to 15.8. And what we'll see here is we go down to the 7 years, 5 years, and 3 years, is that the compound rate over those years is significantly less. So this might tell us that actually the rate over recent years, the growth is slowing down. So that's something we would need to consider when we're looking at Apple. So the 5 years growth here, you can see in the red, has actually been really slow, but it's picking up again over the last 3 years. And you can kind of look back and see what Apple was doing at the time. So 5 years ago, or 5 or 6 years ago, they were seeing some declines in iPhone sales. And that could be part of the reason why they got declining revenues and things like that. But actually, over the recent years, they rectified that problem and have now offered a wider range of iPhone models. So although their sales have actually dropped off in terms of units sold, they've actually increased their revenue on iPhones. So this is now increasing quarter over quarter again. So we'll take into account this information when we're coming to a growth rate, and not going into great detail, but I would say something like 10% would be reasonable, looking at the 10-year average and also kind of how they've performed in the past 3 years. Obviously, this is going to be based on other information as well, which we'll just go and take a look at now. So I've also made my own sheet here where I've added a few things in. This is the total sales going back to 2011 and also the free cash flow. So this is just to kind of give me a few more views on it. 10 years free cash flow has grown 8.23% compounded. And then we can go and look back here. For 7 years, 5.6, and then 5 years, 3 years, and over the past year, which is quite a significant jump. But I don't pay too much attention to just 1 year-over-year result. And we can see the same with the earnings, just under 10% for the compound growth over the past 10 years. So I think 10% is actually a fairly reasonable amount for us to put on for Apple, given the other kind of information I've got from a little bit of research looking into the future prospects of the business. And if you want to put your growth rate to good use, you can actually go and check out my other video, which is on Phil Town's margin of safety, or sticker price as he calls it. That kind of goes into how to use his calculators on his website as well, which you can take this growth rate and then plug that into the calculator there. So as we saw there by the numbers, Apple's a fairly mature business, but it's still kind of it's seen by a lot of people as a growth stock, just because it still manages to grow so much year over year, and it fits kind of into the basket of all those tech stocks that are still kind of growing by quite considerable amounts each year. And of course, we also need to consider that Apple's market cap is around almost 2.5 trillion US dollars. So Apple is already a huge company, so it kind of is fairly reasonable for us to expect that they can't be growing everything, revenues and free cash flow at really high rates, just to the sheer size of the company. But that's not to say that they can't consistently grow at perhaps a rate of around 10% a year compounded for the next 10 years. And of course, Apple is still able to go into kind of adjacent markets. Healthcare is becoming a really big area for them. So this is a huge industry that's kind of working a lot with Apple wearables. So the new Apple Watch and things like that to collect medical data on patients. So this is a really huge area that they can actually expand into. And they're also building out factories in India and other places where they don't really have a lot of market dominance at the moment. So these are kind of a few reasons why I think that it's still quite likely that Apple could continue to grow for the next 10 years at least. And we can also look for the analyst's growth rate in Yahoo Finance. So you can jump into there and see that they're predicting Apple's growth is around 17% over the next 5 years. Now, you should always take this with a pinch of salt, because quite often the analysts get it wrong anyway. So I would always err on the side of caution with this and always look for more conservative numbers. And remember that the analysts are actually only looking over 5 years, and we need to be looking for a growth rate over a period of 10 years. But having said that, you could always look into doing a discounted cash flow where you take the analyst's estimate for the first 5 years and then perhaps you roll them back a bit lower for the next 5 years. And check that the valuations make sense at the end of it, because obviously it's important that your number is realistic. And you can also run a few different models, perhaps like one that's a higher growth, one that's a much slower growth, and see kind of how that affects the valuations that you get back on the company. So a few of the key things we need to note really is just to make sure that the growth rate we're picking is as realistic as possible, based on all of the research that we've done, the past performance, what we see the future kind of runway for growth is within that business, how large the company is, as I've kind of mentioned previously in the video. Picking growth rates is always really challenging anyway, so this is why whatever end number we get to with our growth rate, we're always going to add a margin of safety onto that, because there's going to be probably quite large inaccuracies with our growth rate over a period of so many years. So that's where the margin of safety really comes in. So that's it for the video. I hope you enjoyed it. If you did, please give us a like. Also consider subscribing to the channel as well if you haven't already, and you can hit the notification bell to get notified when I release new videos. And also let me know in the comments below, like, how do you calculate your growth rates? Do you use any free calculators, or do you go about it in a different way? And like I mentioned before, I'll leave the links to the Real One Toolbox and also Phil's calculators from his website as well in the description. So thanks for watching, and I'll see you in the next video. Cheers.